Welcome to Withum's 2021-2022 Global Summit. This year, we have a podcast series with Withum's international team members discussing doing business in regions around the world with our HLB member firms, our clients, and our colleagues. Listen in for discussions to hear how they transact business in multiple countries, to learn about changes in their home country environments, as well as about the culture, cuisine, and must-see sites in each region. Welcome to Withum Smith & Brown's Global Summit. Today we will be talking about doing business in Canada. We are fortunate to have with us today Brett Starkman, who is a senior tax partner with the public accounting firm SLF, Schwartz Levitsky Feldman, in Toronto, Canada. Brett served on the HLB International Tax Committee with me for 20 years, and he is currently on the HLB Executive Committee. We also have David Kersner, who is a cross-border tax lawyer and author based in Toronto at Kersner Law. I've also had the opportunity and pleasure of working on many clients with David. I also have Angela Pulowski, a manager with me in the international group at Withum, and she'll be leading the discussion. Angela, I'll turn it over to you.
Sure, thank you. Thanks for having us, Kimberly. So, Brett, my first question's for you. Perhaps you could start us off by telling us about the types of taxes that Canada has that both businesses and investors should be aware of.
Sure. So in Canada, we have a number of different taxes for the government to raise money. The primary one is income tax. We have income tax for corporations. We have income tax for individuals. Later on, we'll talk about different structures, and there's different taxes for those as well. But basically, both for individual taxation and corporate taxation, there's different rates. And in Canada, our marginal rates go from approximately 20% up to approximately 54%. And you hit that 54% rate when you hit $220,000 Canadian taxable income. We have a threshold that you can earn approximately $13,000 tax-free if you're a low-income individual. Corporations, if you are a Canadian-controlled private corporation, and to meet that definition, you only need to have 50% of the company owned by a Canadian, so it could be 50% owned by a US entity. Entity could be various types of structures, such as corporations, individuals, persons, etc. And the rate for a CCPC, a Canadian-controlled private corporation, is 12.2% up to the first 500,000, and then after that, the tax rate is 26.5%. That tax rate of 26.5% is the same rate for a non-resident owned corporation. So if there's a US individual or a US corporation or other entity that owns shares in a Canadian company, that tax rate will be 26.5% income tax. We also have commodity tax, so GST and HST, which is a value-added tax, just as the Europeans have, and our rates vary upon the different provinces and territories. We have 10 provinces in Canada and 13 territories, and the rates vary. Income tax and GST and HST, they go from 5% up to, I think, approximately 15%, depending upon the province that you work in or the taxable supply occurs in. And there's place of supply rules, which is also, a huge topic that can be discussed for 2 days. I won't get into that. We're just touching the surface today. Then we have payroll taxes. So employees, have payroll taxes, withholding, just like as they do in the United States. Again, there's marginal rates, as I had mentioned, and the withholding taxes are withheld by the employer, and which will be of interest to, obviously your audience who are global. If you do have a foreign corporation that has a branch or a permanent establishment, which we'll get into later, but if there's a permanent establishment in Canada and you have an employee here, you're going to have to withhold taxes and remit them to CRA. Similarly, even if there is no PE, but you have somebody working in Canada, so they do not have the authority to conclude contracts, then in that case, you would still have to set up a payroll account and remit taxes. So anybody that has a US entity and they have somebody just, developing software in Canada, you should be opening up a payroll remittance account with CRA and making remittances for those individuals. Then also the last topic I'm going to talk about for withholding taxes is, again, when you do have individuals coming in from a, let's say, a US company, we have two types of withholding taxes: Regulation 102, which again are the payroll withholding taxes, and then Regulation 105, which are withholding taxes for services. So again, if you have a US company and you come into Canada and services are provided, my company, being a Canadian company, would have to withhold 15% tax on any services your US company would provide. And the only way for you to get that back is if you file a return and it's determined that you do not have a PE. You can also file waivers to prevent the withholding tax from occurring. And I think that's really all I want to get into at this point, because I know it's a lot. And I will hand it back to you, Angela.
Sounds good. Sounds somewhat similar to the US and how we have
very similar, since we're neighbors, right?
Yes, exactly. David, my next question is for you. So what are the primary considerations with the Canada and US treaty? And then can you also tell us about the Canada Treaty Network?
Sure, I would be glad to. So Brett touched on a couple of examples where you have fact patterns with either business operations extending from the US into Canada, which might constitute the nexus of a permanent establishment, or there might be employment considerations. It's important in contemplating the feasibility and design of any business or investment opportunity from the United States or abroad to overlay how does the treaty impact your planning, both in terms of liability as well as reporting. Canada and the US share, I believe, the most complex tax treaty in the world. My book is currently up to 3,000 pages on describing its components. But Canada also has one of the largest treaty networks of any country, close to 100 full double tax conventions. And so we're not going to get into all of the articles, but some of the key articles for business and investment to complement the understanding of how the taxes, income tax and withholding tax, apply by viewing the opportunity through the lens of the treaty is to understand whether or not the treaty would exempt a U.S. or foreign investor from being subject to tax on its net income in Canada. And that's generally Article 7 and Article 5, permanent establishments. Canada and the U.S. have some very unique rights under their treaty. And so it's really important to be very specific and some excellent advantages for businesses in terms of some of the transfer pricing allowances that Brett's going to talk about further. The law, though, that's applicable to determining whether or not this nexus exists is vastly different in Canada and the US. Although they use the term permanent establishment, the case law is very different. And so it's important to understand how your facts measure up. One of the other areas that I think Brett's going to touch on a little later is how are corporations taxed. While it's true generally under the Double Tax Convention, we use this concept of nexus. And in Canada, in the US context, corporations are generally resident where they're formed. With other countries, there can be a broader concept known as resident based on the place where management is controlling the corporation. And this goes back to the English common law case of De Beers at the turn of the last century, 1906. And so it's possible, especially in the digital or e-commerce marketplace today, that you could have someone in Southeast Asia, someone in the United States, someone in the EU, and there could be this question of where is the corporation resident? And while the United States doesn't have this concept, if the corporation's resident in Canada, because that's where the mine management control is, but it's formed somewhere else, that could have a very profound impact. And just one last brief point, Canada, the US have very special rules relating to so-called transparent entities, which may be fiscally transparent in one country but not in the other. And these are what we call hybrid entities, such as S Corps or ULCs or LLCs. And that means that you have to understand how the treaty designates rights for determining is there a permanent establishment. The US and Canada have different tests for that, whether you use the entity or the entity and its owners, as well as certain treaty rights. So I think the takeaway is that it's critical to understand what your particular treaty articles are and how they apply to your investment or opportunity, Angela.
Yeah, thank you for that. And you were starting to touch about the different entity types, so that kind of snowballs us into our next question for Brett. What can you tell us about Canada's choice of business entities?
Okay, so we have quite a few choices, same as the United States. So we have, you can, operate as an individual, sole proprietor. You can operate as a corporation, a partnership, a joint venture. In Canada, we have ULCs, which is a corporation for us, but it can be treated as a hybrid entity for you in the United States. We do not have S Corps, we do not have LLCs. So now I'll touch a little bit on each of them. So I previously already discussed corporations. So if you have a 50-50 ownership with a Canadian entity or a US entity, it would be considered a CCPC, a Canadian Controlled Private Corporation, and the first 500,000 would be taxed at 12.2% tax. Anything over that, 26.5. If it's majority owned by a non-resident or a U.S. entity, it's going to be 26.5% from $1. Partnerships and joint ventures, they're used for different things. Normally, a partnership is a long-term relationship, such as law firms, accounting firms, etc. Whereas joint ventures are normally used for temporary projects, such as real estate development, etc. Now, one key difference between a partnership and a joint venture is, just as in the United States, we have discretionary deductions for depreciation. So in a partnership, depreciation must be taken at the partnership level. But for a joint venture, depreciation can be taken at the individual level, even though both are flow-throughs for tax purposes because partnerships and joint ventures, neither of them are taxed in Canada. The actual ultimate owner of them is taxed, whether it be an individual or a partnership, like another partnership or a corporation, family trust, etc. So you're taxed at the ultimate level. But as I said, with a joint venture, you can claim the depreciation at that ownership level. ULCs are taxed as corporations. So, you know, in the United States, if you set up an LLC to do business in Canada, what's going to happen is that you'll do business in Canada. If you treat it as a flow through, you could have mismatching of foreign tax credits. So just a second on foreign tax credits. If, you know, Kimberly, as a US citizen and resident, does business in Canada, and she earns income in Canada, she's going to have to pay tax in Canada. And now when she goes to do her US return, she must pick up that Canadian income, but she's going to get a foreign tax credit for the taxes she paid in Canada. So when you're dealing with hybrid entities, as David mentioned, such as, you know, ULCs or S Corps or LLCs, and you're earning income in Canada and you're not treating it as a corporation because we don't have hybrids, what happens is that you would flow the income up to the US and you would pay tax in Canada. You guys would take a foreign tax credit, but in Canada, that income doesn't get flowed out. That tax would be taxed in the company. And then later on, when the individual takes the money out in the form of a dividend, there's no foreign tax credit. So you will have effectively double taxation. So you have to be very, very careful when using hybrids in Canada and the US. And so Kimberly and I have worked on many, many clients together where we have to structure, you know, the clients accordingly so we don't have any leakage. And David, I think you wanted to mention a few things from a legal aspect, a business plan, et cetera.
Yeah, just very briefly, Canada is one of the most advanced regulated economies in the world. And as part of your feasibility, Kimberly, Brett, and I have always collaborated with the view of bringing all the multidisciplinary stakeholders to the table, because it's critical to know up front, are there any showstoppers in terms of regulatory deals. I worked recently with Kimberly on a cross-border healthcare solution that a preeminent healthcare law firm in Ontario was able to point out that just didn't have viability, and so they've had to go back and rethink their planning. So it's critical not only to do the tax analysis that Brett's talking about, but to also make sure it has feasibility. And lastly, one of the hallmarks of our collaboration with Kimberly and Brett has been to model financially some pro forma business planning or investment planning so that we can validate what the cross-border integrated tax cost is going to be, and you can see those numbers and be able to further make wiser choices. So the choice of entity is one of the most important considerations, but as part of that, there needs to be a perspective that in the end provides some strategic depth to the planning.
Yeah, it's always nice when clients bring us in ahead of time to make sure that that planning is what they want, you know, to meet their goals. So, David, my next question is for you. Can you share with us some of the considerations that come to mind regarding digital or e-commerce?
Sure. So traditionally, the two main questions in e-commerce planning have been within the areas that the treaties allow historically source countries to tax residence countries, and that considers the hardware or the e-commerce activities such as an internet website, computer server, an internet service provider. And historically speaking, if all of those are in Canada and you're doing business in the US, or if all of those are in the US and you're doing business in Canada, that's going to make it less likely for Canada to be able to tax the net income. The other area related to e-commerce taxation here is on Article 12 of the treaty and royalties. And that looks at the character of payments received in transactions involving different aspects of computer and cloud-based software. And so it's very important upfront with any e-commerce planning to understand how is Canada going to characterize the business offering that is being provided. Is it going to be in the form of some kind of a royalty or intellectual property or license such that Article 12 would apply, or is it going to be more in the form of a service so that without a PE there won't be any tax? With respect to Brett's earlier comment on Canada having a VAT or commodities tax, as of July 1st, 2021, non-resident digital platform operators are now subject to registering, collecting GST and HST if their sales are at least $30,000 over the last 4 quarters. So that may be another hidden obligation that may not be intuitive. And I guess lastly, Canada is participating in the BEPS measures for enacting a global digital tax, and that's been a very controversial area in some countries. But basically, this is set to come online January 1st, 2024, a digital services tax, which would apply to companies that are very, very large with revenues of more than 800 million. Angela?
Yes, thank you. So this next question is for both of you. Either one of you could answer. Can you share with us some of the major reporting or compliance issues that businesses contemplating expanding to Canada may wish to know about?
Sure, I'll take a stab at that, and I'll have David help me where he wants to jump in. So in Canada, and I guess we'll talk a little international flavor because we're speaking to a global summit, and so you're not interested in our Canadian taxes. You're interested in how you can avoid having penalties, etc. So just a few things to consider. So David and I both have brought up the concept of permanent establishment, and that's in the Canada-US treaty. And basically, if a foreign entity, and we're going to call it a US corporation for now, sets up business in Canada through, let's say, a branch, and they have operations in Canada, so they have a fixed place of business, you would have a permanent establishment or a PE. In the Canada-US treaty, we also have deemed PEs, so you have to watch that. We have very little time, so I'm not going to get into the details of that. Just be aware, and when you're speaking to Kimberly or David or myself, we'll take all that into consideration when we listen to the fact patterns. Another thing that is considered that David mentioned was minded management. So if you have you're doing business in Canada, excuse me, and you're trying to avoid a PE, but you actually have minded management in Canada and you have the authority to conclude contracts, etc., you're going to have a PE in Canada and you're going to be subject to tax in Canada. So you have to be mindful of that. And then if you are doing business in Canada and you are subject to tax, you have to comply. Otherwise, we do have penalties. Our penalties are not nearly as strict or as expensive as the United States. I think we're a tenth. Our population is a tenth of the U.S. So our penalties are a tenth of the U.S. So your penalties are like 25,000. Ours are 2,500. But still, it's per occurrence, and they can add up. So make sure you're filing your tax returns. Make sure you're filing the HST returns. Make sure you're filing, your payroll remittances, etc. And those are things that you need to consider. The other thing that David mentioned that I would talk about, and I'm going to throw it back to David too, but I'll just briefly touch on it, is transfer pricing. So sometimes when you have a global structure and you have companies in Canada and the US and other countries in the world, you're going to want to minimize taxes in certain jurisdictions, especially the higher tax jurisdictions. So if I'm, making widgets in Canada and, a US parent owns the Canadian entity, the Canadian company, and the widgets in Canada are very, very profitable. What's going to happen is they're going to want to minimize the taxes in Canada, and they're going to, want me or the Canadian company to sell those widgets back to, let's say, another US company that's going to be selling in the US, but they want me to sell it for a very, very high price because our taxes are higher or we have so much profit. And in the US, you'll sell it, and let's say your taxes are lower, okay? Therefore, you're going to have less tax on a global basis. Well, Canada and the US, they don't like that. So what they do is they say, no. We have certain rules and certain methods that you need to determine transfer pricing from one jurisdiction to the other. So from Canada, if I'm manufacturing in Canada and a US entity is selling and I'm selling to that related non-arm's length entity, we have to have a transfer pricing study done to determine the appropriate prices that should be charged from the Canadian entity to the US entity and vice versa. I've just given one example. David, do you want to add anything further?
It's usually, if the investments are coming from the US, it's possible to leverage off of both countries and the treaty's adoption of the OECD principles. And in our past collaboration with Kimberly and her international team, we've been able to put together transfer pricing studies that would be respected by both the CRA and the IRS as meeting the arm's length principle for related party services or intellectual property, or as you mentioned, selling of goods. So the upfront investment in this advice, which is highly specialized in something that Witham is very expert at, enables the C-suite to have some peace of mind that a CRA agent can't just show up and start imposing their own demands on the company, because if the proper prudence is put into place, you will be armed to have the right quality studies to demonstrate the support for your transfer price.
Transfer pricing is definitely a hot topic, and it's only growing, especially here with them. So I have one final question for both of you, and it's probably my favorite. Can you tell us 3 things that are unique to Canada? So let's hear about what your favorite food is, or what's a famous food to try. Maybe what's a tourist hotspot? What should we see when we visit Canada? And then what holidays are celebrated?
Okay, so I will take the first stab at it. So Canada is multicultural. I mean, we probably have more immigration in Canada than any other country in the world. So you name it, we got it. You have Korean, Chinese, Japanese, Lebanese, Mediterranean, you have your steak and seafood, you have your Italian. I can go on and on all day. So Canada, we are very, very fortunate and very, very lucky that we will never get bored of food in Canada, because we can go to all these different restaurants or, you know, specialty markets and get all these various foods. I mean, me, I'm a simple guy. My favorite foods are steak and seafood and Italian, because, you know, I grew up on that. But I really, really enjoy trying all the different types of foods. So one thing that I know almost as much as tax is food. So I'm a foodie, and I love eating. So that's food.
But Brett, this is Kimberly. What's truly a Canadian food? Is there anything that's truly Canadian?
There is no such thing, because Canada is made up of all these different cultures. I honestly, bacon and eggs are Canadian. Yeah, you know, I don't know what you would call a Canadian food, because we are truly a multicultural country.
I thought Montreal especially was known for its smoked meats, and that was really Canadian.
Kimberly, I'd have to say that in terms of, Angela, your question about travel and culture, I think that Quebec is an outstanding place to consider traveling to for the wonderful, rich cuisines, such as the smoked meat, or some of the places that have their famous Montreal lox and bagel sandwich beauties. There's Quebec City, which is one of the most enchanting, I think, places in all of North America, with extraordinary culture in nearby the mountains and Massif for skiing. I personally love making pancakes on the weekend, and I am a big investor in Canadian maple syrup. And I used to bring that back in the day when it wasn't so strict, to visiting my American friends. And for people that have also wanting to travel different places, Newfoundland is an exquisitely beautiful place, both in terms of the kindness of her people and the natural beauty. I know Brett has traveled extensively in the Canadian Rockies. There are many places to visit in Ontario, Niagara Falls and Niagara-on-the-Lake, the wine heartland of Canada. And we hope that you had a nice time when you were last here, Kimberly, although it was probably too busy for you to see any of those places.
Yes, but I did make a run by Niagara Falls. I had never seen the falls before, so the last time I was heading to Toronto, I went to the falls. I've also been to Banff and seen Lake Louise, which is spectacular.
Yeah, and Niagara Falls are like one of the 10th wonders of the world, so it's spectacular. It's about an hour and a half away from Toronto. If you're in Toronto, I mean, we have the CN Tower. At one point, it was the largest, highest structure in the world. There's a restaurant at the top there that you can eat, and it rotates 360 degrees. So you can, see the city eating in there. We have the Ontario Science Centre. We have theater that is probably, second or third to London and New York. I've been to theater in London. I've been to theater in New York, and I love theater. And Toronto theater is just as good. We get the same actors and actresses. It's fantastic. So there's a lot to do in Toronto. I mean, it's the biggest city in Canada. We do not have smoked meat as an origination, but all our delis, we do have smoked meat. I got to be honest, Kimberly, I forgot about smoked meat because I'm not crazy about it, but I love maple syrup.
Okay. Well, hopefully
And
this
it goes
has,
well with David's pancakes.
yeah, hopefully this has encouraged some of our listeners not only to do business in Canada, but to visit Canada and enjoy your spectacular sights and your wonderful maple syrup, and even the smoked meats, even though it's not a favorite of yours.
Most people love smoked meat.
Great. Well, thank you, Angela, for leading this discussion. Thank you,
very
Brett
much.
and David, for your insights. It's been
Thank you
fabulous.
for having me.
And I look forward to continuing to work with you. It's been a fabulous relationship.
Us too. To
Okay.
another 20 years, right, Kimberly?
I hope to retire before then, but here we
You
go.
and I both.
Thanks so much.
Thank you, guys.
Thank
Take
you.
care.
Bye-bye.
Bye.
Bye.
Thank you for joining us today. I hope you enjoyed your virtual trip to another region as much as I did. Please join us again as we continue to roam the world.